Now we're moving on to our Fireside Chat, the culmination of a fantastic day. We thank all of our presenters and all of our moderators for bringing such a full, packed day of information for what's going on in the industry and some of the bigger issues of the day. But now we're going to meet those bigger issues head on. As I've been talking about for a couple of days, I think everyone knows how excited I am to have David Rosenberg as our keynote speaker today. Him and I are going to have a fireside chat and taking on what is going on in these very atypical, tumultuous times that we all find ourselves in right now. Let me tell you a little bit for those that don't know about David and his track record. He is the president and chief economist and strategist of Rosenberg Research and Associates, which is an economic consulting firm that he established in January of this year. Prior to Rosenberg Research, David was chief economist and strategist at Gluskin Sheff and Associates from 2009 to 2019. From 2002 to 2009, he was chief North American economist at Merrill Lynch in New York, during which time he was consistently ranked in the Institutional Investor All-Star Analyst rankings. And prior to that, David was chief economist and strategist for Merrill Lynch Canada, and he was based out of Toronto, where he and his team placed first in the Brendan Wood survey of Canadian economists for 10 years in a row. Yes, 10 years in a row. David received a Bachelor of Arts and a Master's of Arts degree in economics from University of Toronto. And we are thrilled to have him here today. David, there you are. Really an honor to have you here, David. I've been a reader of your research for a long, long time. I had been reading your research, but one thing that really stands out for me and my wife, we were dating at the time, but went to see you at the Monk debates back in 2011 when you took on Larry Summers there around the growth, the pitcher for global growth at that time. I don't remember that's going back 9 years. I don't know if it meant more to me than it did to you, but that was a great debate. And you really held your own with Summers on that one. That's for sure.
Yeah. And I would still say his elbows are sharper than mine, but the scars have healed, thankfully. That's what 9 years will do.
Yeah, there you go. That's what 9 years is for. Build up those calluses for sure. David, wow. I mean, who would have thought we'd be in times like this? And that's why we thought it was so important for all of our viewers and leaders to bring someone of your ilk on board to try to really tackle some of these big issues and give us some clarity on them. We could think of no one better than you to provide that. For those of you who aren't with Rosenberg Research, you can go to Rosenberg Research's site and you can do a 1-month trial. So I highly, highly recommend at least at minimum doing that, seeing all the great reports. Breakfast with David comes out every morning. And that's where you need to go to really stay on top of what is happening. David, why don't we start with the big news? I've been reading your reports all week. Obviously, the vaccine, we started the week with that. We have to get into U.S. elections. We have all this stuff to get into. But why don't we start with the impact of the vaccine? Is this a really big deal? Does this materially change outlooks on global growth patterns going forward into 2021?
Well, look, I always said that the vaccine was going to be a huge game changer. And I think that every economist pretty well had in their forecast for next year, or they should have had, a vaccine that's effective, that comes to the market, that we will all somehow become inoculated, at least in North America. My guesstimate was going to be a second half of the year story, maybe early 2022. So I was sort of in the Anthony Fauci camp that it was going to be later rather than sooner. I think that, the excitement, at least initially, over the Pfizer announcement was really twofold. The first was the speed at which they say they can get the vaccines ready to emergency workers, frontline workers, in the next couple of months. That was actually a big surprise. And I think the really big one was the 90% efficacy rate, because, that's like what the shot is for the measles. That basically would eliminate almost all the uncertainty. You have 90%. That is the gold standard. Most people thought, well, maybe it'll be, 60, 70 max. Look, that was big news. It was still a preliminary trial, but it exceeded expectations, and you saw the market reaction. I think that we have Moderna, we have a lot of other companies that have a very similar model as Pfizer has. So we have to have that assumption that we're going to get to the other side of the mountain. It's really a question as to when. I think that one of the concerns was going to be, will people take the vaccine? Won't there still be a lot of people that won't take the vaccine for whatever reason? But look, if we have 90% efficacy levels, you won't need everybody to take it. So look, it's very big news. We'll see the extent to which it comes to fruition. I think that it's going to produce what you think it would produce. The day we get the vaccine, the very next quarter, maybe 2 quarters, we're going to have a huge pent-up demand boost in a lot of the areas of the economy that we either have shunned or we've been told not to go to. And principally travel and leisure, tourism, people will start to fly again. So we will see a couple of quarters of a huge bounce. And then the question is going to be, what does a new normal look like? Like what everybody talks about going back, to some normal. And I would say that there's going to be a new normal, not an old normal. It doesn't mean that we don't go back for a while and spend more money and get more re-engaged. But there's been a lot of fundamental shifts that have already occurred that aren't going to change. And one of the things that I've been talking about is what I call the homebody economy, the stay-at-home, work-at-home economy. That's here to stay. And you're going to find that compared to what life was like before, a much larger percentage of the working population is going to work at home. Not everybody, but a lot of people want to work from home. Maybe those of us that don't have little kids running around, but a lot of people have found that A, they're more productive at home, B, and this is what I hear over and over again, and it's in the survey data, the amount of money and time people are saving by not having to commute from the suburbs to the inner city core. So I think that, after all the investments that have been made on remodeling your home and rewiring your home to become your office, that was really an investment. And so where we work, how we travel within the city itself is going to change materially. And that's why I'm saying that if to varying extents, things will come back. What comes back the latest and the least is going to be office real estate. I think that's going to be an overhang for a long period to come.
Interesting. On the positive side, how does one partake in that homebody thesis, given that you can only renovate so much? Kind of like once you've done your house, it would make sense, the Lowe's and the Home Depots of the world. But how do you continue to partake in that going further out?
Well, you're right on that, but I think that the servicing side, the ongoing money it's going to take, whether it's through upgrading or through internet services, telecom services, all those services that you're going to need to run your office in your home, that's going to be recurring expenditure. You're 100% right. You're only going to remodel your house once. You're only going to, renovate your backyard once or maybe once every 10 years. So that part is 100% correct. But then you take it to the next level, which is, well, you spent all this money remodeling your house to become your office, or remodeling your house because you're spending more time in it. You're going to want to spend more time in it. And the same holds true, with your backyard and the new deck that you built. It doesn't mean that you're not going to go take vacations, but at the margin, you're going to spend more time doing things in your house. Look, there was a big article in the New York Times today about how so many new expensive homes, bigger homes, are being purchased. Why is that? Because people came out of the pandemic with a secular shift in attitudes, and what they have a greater appreciation of is open space. And you can imagine all those people with young families living in small condos or apartment buildings on the 30th floor where they were scared for months to even take an elevator. And that's why you're seeing this really big, and I think sustained boom in the demand for residential real estate in the form of what I call bungalows in the burbs with a backyard, because I love alliterations. But we have that desire now coming out of the pandemic, a much greater appreciation. I mean, not just for hygiene and all the stuff that we take for granted, but a much greater appreciation for open space. And that's why you're seeing a shift from multifamily to single family. But you're quite right. We had a boom in remodeling. That's not going to be sustained. I think the growth will be sustained, not at the trajectory that we were on. But I think that the servicing side, when you're talking about the service providers, especially in technology, in delivery services, technology services, internet services, that's a recurring, and you want to actually focus your investments to some extent in those companies that generate that recurring cash flow stream from the work at home theme that I don't think is going to be going away anytime soon.
Okay. Let's continue with this secular kind of shift. So secular shift around real estate and around how we're living. Let's extrapolate and move over to the bond market a bit. You had a really interesting one in your Breakfast with Dave note from the other day about, I couldn't believe it, about Greek yields being like something ridiculous, like 6 basis points, like just crazy how low they are. What is that telling us about the bond market? Is there a secular shift going on there as well? Please explain this to me. How is that possible?
Well, I know but this is the world that we're in. We're in a world where central banks have taken over. Whether it's Jay Powell or whether it's Madame Lagarde or whether it's any major central banker right now is operating a casino. And people like Jay Powell, as an example, they're the blackjack dealer handing out the chips for free. So. Actually, the 2-year Greek bond yield is negative 6 basis points, negative 6. And their 10-year yield is trading 15 basis points below where 10-year treasuries are. Now, say what you want about the United States. Go ahead. It is still a AAA rated credit. It's still AAA. In the land of the blind, the one-eyed man is king, and the U.S. is still AAA. Greece is junk. That's a junk bond.
Yeah.
So we live in a world of the capital markets where a junk bond credit trades at a negative yield at the front end of the curve at a discount to the most liquid and safest security on the planet, which are U.S. treasuries. And it just leads you to believe all the manipulations and intervention by all these central banks. I went into this situation, this pandemic, and I was saying for a while, I'm really worried about the next recession because the Fed and other central banks are out of policy bullets. The Fed is out of policy bullets. We went into this mess with the funds rate at 2%. Historically, in a recession, the Fed cuts the funds rate by 5 percentage points. I was saying, well, are they really going to get the funds rate to -3? Mm-hmm. Now, we saw what they did in the last cycle, right? Well, they did the quantitative easing. They bought treasuries, AAA. They bought AAA mortgages. But look what Powell did this time. Bought CMBS. They bought corporate bonds, investment grade, but the big kicker was high yield. When you saw, basically, even in the context of the economic data going vertical down, the stock market surged. Yeah. Everything surged from a risk asset standpoint because people started believing, boy, if they're going in to buy high yield, and high yield resides in the capital structure right next to the equity market, I was getting questions all the time. So what's next? Are they going to actually start to buy equities?
Yeah.
And so, but that's the world. So basically what I was saying, if you remember, the tagline in that report that I wrote in Breakfast with Dave was, it's a mad, mad, mad world. Yeah. And it just goes to show, like, here, so many people went to business school and finance school learning about Harry Markowitz's Nobel Prize winner in finance, the capital asset pricing model. Well, what interest rate are you going to use? Yeah. And so that's where, when we're talking to investors, and people are saying, well, look, why is the stock market doing what it's doing? And this is actually, it's one thing to have the market go up when the data is going up. When the data was going down, the stock market was surging. But what's the valuations you put on anything? When you have over 17 trillion, see, Greece is just an extreme example because Greece is in Germany. Okay. It's a junk bond trading with a negative yield. But we have over $17 trillion of bonds globally. That's with a T. 17 trillion. You're talking like a third of the global bond market trades with a negative yield. So how do you do valuations when you're doing your dividend discount model or you're doing your cap rate model for real estate? You're trying to discount future cash flows. Well, in a negative rate world, they just go to infinity. So what I'm saying is that it's very difficult. What I try and do is try and attach some common sense and fundamentals to the analysis. But I think that the central banks in some ways have really destroyed any semblance of risk versus reward in an organic sense. And I would just go to the corporate bond market. Seriously, do you mean to tell me, we call high yield today the junk bond market. Okay, we won't call it junk. We'll call it high yield. High yield. 5% is high yield today. 5% is high yield. Where treasury yields were trading a decade ago, that's, you see, high yield, which is really a bedrock of the fixed income market.
Yeah.
High yield has become an oxymoron. 5%, people buy 5%. Portfolio managers are buying 5% high yield bonds. There's not a snowball's chance in hell that compensates you for default risk today.
That's it.
Or default risk down the road. So what I'm saying is that the central bankers, in the name of the greater good, because they can only operate their policy through the financial markets, and then the financial markets, they hope, has an impact on the real economy. They're flying blind and they're massively desperate because of the COVID and all the economic damage that's been done. It's fiscal policy, and this is one thing I agree with Jay Powell on 100%, is fiscal policy has got to be the answer. And then we have to basically decide, as we come out the other side of the mountain, how we're going to redress all these massive deficits and debts.
That's such a huge statement. So you feel that the monetary policy no longer has the torque. It can't. That's what we're seeing right now. That's why these valuations are just going crazy.
Look, I did say, I would say I was mistaken to say that the central bank was out of bullets. They were out of, I should have included this word. They were out of conventional bullets. Mm-hmm. Now, remember, quantitative easing, the way we knew it in 08 and 09, buying treasuries. Oh, that's so passé. Or buying AAA mortgages. So conventional, nobody even heard of QE. Who heard of quantitative easing before 2008? Well, Ben Bernanke did, but who in the investment business knew about QE? Oh, but let me tell you, in the past 10 years, my kids, when they were in high school, knew what QE was. Who didn't know what QE? But QE did not mean the central bank coming in and buying junk bonds and then having people saying, well, I bet you equities are going to be next. And then the greater fool's theory, I got to come in and buy equities before Jay Powell does with BlackRock as his asset manager and advisor. So it seems to me that the central banks, are they desperate? Obviously, when you're coming in and buying high yield bonds to generate risk appetite in the hope that that's going to resuscitate the economy, you're pretty desperate. It's a very weak link. It's very obvious. Look, the economy right now, we had the detonation in the second quarter. We had the nice snapback in the third quarter, but the snapback in the third quarter, whether you're looking at it in the US or Canada, was all fiscal policy. That was all the government basically giving you money to stay alive or to spend. And actually they gave you more than what the economy lost. So we had this gargantuan rebound in the third quarter, which was basically government transfers. That wasn't monetary policy. What monetary policy gave you was a huge bull market in everything except maybe cash. So the central banks gave you dramatic asset inflation, financial asset inflation in particular, has a very weak link to the real economy. Mm-hmm. And we all know that even in the old days, when all we talked about was interest rates, the lag between what the Bank of Canada or the Fed did with interest rates would hit the real economy, Main Street, with lags that were 4, 6, 8 quarters. The central bank always operates with lags when it comes to the real economy. But when we talk about the financial economy, bang, day one. But the link between Wall Street and Main Street, or Bay Street and Main Street, it's a very loose link. So in answer to the question, yeah, I think that the central banks have, look, when you read the words coming from Jay Powell this year, it sounds like he's gone from an investment banker, which was his previous profession, becomes a central banker. Now he's almost sounds like a social worker. And I tip my hat out to him because he's got a big job and the economy is one of them. But the Fed is a really ultimately a provider of liquidity. We also find out that they can manipulate asset markets. But if their ability was to resuscitate the economy on a durable multi-quarter acceleration process, after everything they've done, including boosting the money supply 25% in the process. Very loose link between what they're doing and what the real economy is doing. And what they're doing with financial assets, though, is very interesting. It's basically easy peasy. You're an investor. That's how these Robinhood accounts are popped up. Just basically pin the tail on the donkey. That's what this game has become. Investing shouldn't be that easy, but the central banks have made it that way.
Well, and if I'm following correctly, so normally we think of back in the 70s, monetary policy being about driving rates down and getting the economy going that way. Then you get to near zero, you can't do that anymore. So then we have quantitative easing, right? Then it's just buy financial assets, release money into the system. There's only so much of that you can do. So now we're into fiscal where we're putting payments straight into citizens' pockets, I guess, in a way. What does all this mean? What does that trajectory tell us about the value of money and how that wraps in with inflation and what that could mean for gold? Can you?
Well, absolutely. Well, when we talk about gold, we can talk about a bunch of different things with gold. The fact that it has a almost perfectly inverse correlation with negative interest rates. We have an unprecedented $17 trillion of negative yielding fixed income instruments around the world. I expect over time that number is going to be getting bigger, because even once we get past the worst part of the pandemic, the numbers are getting a lot worse now. We all know that, but we'll get to the side of the mountain. But there's still going to be a lot of permanent damage to the economy that's got to be restored. It tells me that central banks are going to remain super accommodative for a long period of time. That tells me that two things. Firstly, that real interest rates are going to stay negative for years to come. That is an ongoing source of support for gold. Now, look, there could be, it doesn't go up every single month as we've seen in the past couple of months. And there's a variety of factors that we have to look at on the demand side. But on the correlations with negative rates, the opportunity cost of owning gold is the coupon, and the coupon globally keeps on going negative. Point number one. Point number two is that the central banks, even once we get past, the opening question was about Pfizer. Okay, we have to assume that at some point we're going to get to the other side of the mountain. I mean, even in 08 and 09, we didn't need a vaccine at that point. We just needed the banks to be bailed out. Mm-hmm. Once Geithner and Bernanke firewalled the banks, we went. We didn't have a skyrocketing economy, but the worst was over. Bernanke kept on easing policy, right through to 2015. Gold just kept on going up. And so even past the worst point of this pandemic cycle, I expect that the central banks are going to continue to do what they're doing. That's going to be very bullish for gold. And I look on the supply side. As an economist, people will always say, what do you think the price of real estate is going to be, the price of equities, the price of commodities? We're talking about the price of gold. But nobody ever says, well, Mr. Economist, how do you come up with that answer? Well, the economist should tell you, well, here's the thing. In Economics 101, they teach you how to draw these two curves. One's called supply, one's called demand. And we have to know how to draw the direction of those curves and what the shape of those curves look like. Because we all know that at the intersection of supply and demand is the holy grail called the price. So when you ask me, where's the price of gold going? I have in my framework where supply and demand is going. And of course, we're measuring gold in dollars, or we're measuring gold in fiat currencies. What we know is that not just the US dollar, every central bank is in this together. Global fiat money is growing at a 20 to 25% annual rate. The production of gold globally is going up at a 1% annual rate. So that tells me, if I have a real fundamental view of just what the relative supply curves look like, gold is going to remain in a secular bull market, and there's going to be periods for a variety of reasons why gold might pull back. And, it's interesting about the sentiment the past couple of months, with the risk on trade coming back. We saw what happened on Monday with Pfizer gold. People say to me, oh, should I sell my gold? I said, what? No, actually, I think that you should be buying at a better entry point, because this is a fundamental secular bull market. But it's very interesting that when it comes to the equity market, every single dip is to be bought. Every dip. In fact, people, when it was down 30%, you had people on Bubble Vision saying, got to buy. God forbid gold pulls back 3%. And I got people saying to me, should I get in my gold position? I'm saying, that mentality alone from a contrarian standpoint is actually hugely bullish, but it's a very interesting commentary. So much of what we do in the markets is psychology driven. But people are so nervous about gold, they're not nervous about equities.
What is that psychology? What does that play there? Do you
greed?
think?
It's all about greed. It's all about greed. Nobody is buying gold for greed. You're buying equities for greed. Right. Okay. I don't hear people talking to the Robinhood accounts saying, "Oh, I'm going to be buying gold on margin." No, so it's about fear and about greed. And the thing about gold is that you're really buying it. I'm not going to say on fear. That's an exaggeration. Gold is a ballast in the portfolio. It is like having high quality, long duration bonds in your portfolio. It's a ballast. It's a source of stability. And it's an insurance policy against things going wrong, because when things go wrong, central banks tend to print a lot more money, and your gold is tangible. Your gold is real. Look, it's no different, than buying real estate. It's just that, you can go buy a piece of real estate is a lot more expensive than buying an ounce of gold. But the point I'm making is that it is an insurance policy. I say to people all the time who don't have gold in their portfolio or the gold mining stocks in their portfolio. Of course, when you buy the gold miners, you are involved in the equity market, but it doesn't have the same correlation as, say, technology does. And you'll get more of a torque in the portfolio if gold continues to go up, which I think it will. But I say to people, like, you do have home insurance, right? Yeah, you do have auto insurance. You have so gold is an insurance policy against things going awry. That you do want to have a tangible asset.
Is your feeling that
your financial exposure in your portfolio? That's where I come out of it.
Is your feeling that given the atypical times that we're in, is it wise to buy more insurance? So the old rule of thumb with gold is maybe 10% of your portfolio. What's that percentage given the mad world we're in your words?
Well, it depends on so many things. It depends on your age. It depends on your cash flow needs. And it depends on your tolerance for risk. So it's the one thing that I did learn, those 10 years that I had, those last 10 years working on Bay Street on the buy side, you really do learn that that rare is the day that two different families or two different people have the exact profile. So I could say to somebody 10% is not enough. And I could say to somebody 10% is just right. But if I draw in the curve, I wouldn't say right now for anybody 10% is too low. I'd say that'd be the low end. But this is talking 20% or 15%. I'd have to get to know. I mean, I wouldn't make a blanket statement that in a particular blind asset mix. I don't even know in a traditional asset mix how that even factors in anymore in a world. See, in a world where Greek bonds trade at a discount to treasuries, in a world where central banks are buying junk bonds, in a world where everything is so topsy-turvy, I don't even know how you can talk about a really appropriate asset mix. But I would say that whatever it is, your gold exposure should be something above zero. 10%, I'm perfectly, if you're going to say it, a blanket statement. If you asked me, actually, I would have said probably 10% is appropriate. But for a lot of other people, it's a lot more than that. I've been advocating actually something a little more diversified, which has been, once again, in the name of alliterations, I've been calling it the bond bullion barbell for the past several years, and it's done remarkably well. In the past couple of months, has it had a bit of a sputter? Yeah, but that's life in the financial markets. Yes. But I also like 30-year treasuries as well. For a very similar reason. In terms
the bond bullion barbell is 10 years with bullion?
I'd say, bullion. So I'm talking about either physical gold or buy, I'd say, a high quality gold company, but the bond bullion, and then own long dated treasuries against that. Yeah. Okay. If we get the inflation, gold's going to rip because of its classic store value characteristics. Obviously bonds won't do that well, but it's a nice barbell. The thing is that they both will do well. See, I still think we're in a world of deflation. We got those CPI numbers today, right? We got the CPI, the inflation numbers, and I'll tell you why people have the wrong idea. They think there's inflation because they're watching the CRB index, and they're watching iron ore, and they're watching aluminum, and they're watching copper. And they're building this view that, well, we have commodity inflation. Last I saw, nobody walks into Walmart and is looking for a pound of copper on the aisle. I don't think that's what they do. We're a service sector economy. You see, the most important determinant of inflation, by the way, and let's go back and read Adam Smith and David Ricardo on what's called the theory of rent. And rental rates are deflating. There's an article today in Manhattan where rents are actually declining almost 20%. That's true across the country. And residential rents are basically 40% of the core CPI, 30%. And that's not just that, but you're seeing other service industries. Historically, service sector doesn't deflate. Historically, service industries have pricing power, and what has deflationary power is the durable goods sector. But what's interesting is that the durable goods sector indeed does have pricing power, don't get me wrong, but that's only about 20% of the pricing pie. 80%, we are a service sector economy. This is not the economy of Davy Crockett. So services are actually deflating, and that's being driven a lot by rents, and that's going to continue for some time. Bonds are a great hedge against deflation, but guess what? Everybody talks about gold as a hedge against inflation. It's equally a hedge against deflation, because deflation in a period of these massive public and private debts globally increases the real cost of servicing that debt and creates financial instability. And it forces central banks to become even more aggressive. So people don't see that gold as a great hedge against deflation. It is. And so are bonds. And I think at some point we will get inflation, but it could be 5 years down the road. I'm not interested really. If somebody ever wants to say to me, what does life look like 5 or 10 years down the road? I'll get into that with them. But that's like, as far as I'm concerned, that's like, talking about dessert when we're still serving the appetizers. The output gap, the gap between aggregate supply and aggregate demand. I talked before about what does the economist bring to the table, in addition to the fact that we just are a fun-loving group of people, is that we're trained to draw these supply and demand curves and present it in a coherent way to say that actually for the next several years, deflationary pressure is going to dominate. Guess what? You want to own gold in that environment too.
Yeah. That's really interesting, that kind of a time period a couple of years out, because I was going to ask you about inflation, but you've tackled that now. For those that really are, though, worried about inflation coming in at some point, what is the leading indicator? You've talked about all that money being out there, but we know the velocity of that money is quite low. Is that velocity, is that what people need to look for when that picks up, that we could then have a wave of inflation, or is that overly simplistic?
No, I think that look at that. That's the classic Fisherian identity, or what they call the quantity theory of money. I'm not going to get out a blackboard, but MV equals PY. M is money supply, V is velocity. That quotient is equal to P times Y, which is the price level times real economic activity. So you solve for that, and of course, velocity is key. Because people have been wondering for a long time, how could we have all this money printing, no inflation? It's because velocity has been contracting. So what am I watching? Money velocity. We get that data every month. I'm watching it like a hawk. Absolutely. And that's one data point. And you can't just look at one data point. I'm really looking more, because I'm consumed. When people say to me, what keeps you up at night? The answer hasn't changed in 35 years in the business. The answer never changes for me. What keeps me up at night is like, what's my blind spot? Yep. Where am I going to be wrong? Where's the hole in my forecast? I don't spend too much time patting myself on the back, because nobody's got a perfect track record, that's for sure. But we have to be cognizant of the fact that we're human. We're going to make mistakes, and I'm always looking for my blind spots. The blind spot, I don't think, is going to come from the demand side. I don't think we're going into some, if you're going to ask me, are we going to go into some post-COVID economic boom? We're going to get tremendous demand growth. Come on. How's that going to happen? How is that going to happen? The reason why we didn't get the big inflation with the other quantitative easing in the previous 10 years, if we didn't get the inflation then, how are we going to get it now? Because the fundamental structural factors that impeded the inflation cycle was excessive indebtedness. Excessive indebtedness is a source of deflation, not inflation. It is a huge constraint on future spending. and we have aging demographics. Aging demographics. And unfortunately, look, we lost a lot of older people with the COVID, but the reality is that the aging population, the retiring boom amongst the baby boomers, that's just accelerating. And then we come out of the other side of the pandemic with even larger deficits and debts. And I've got news for you. Dealing with the deficits and debts is going to be an added constraint on future demand. Where I'm going to be wrong on the inflation, when people say to me, so if you're wrong on the inflation, it's not because I think we're going to have a demand boom. I'm worried about the supply constraints. I'm worried that when I talked about before about, the economist has to not only be concerned about how these curves are shifting. I know I'm sounding like an economic professor, but the shape of the curve is also very important. The more elastic the supply curve is, and remember Ronald Reagan, and then really followed by Bill Clinton, created a very elastic aggregate supply curve, which is why we had tremendous growth with no inflation, as Alan Greenspan picked that up in the mid-1990s. I'm worried about the supply curve becoming more sclerotic over time. I'm worried about the supply curve becoming more inelastic, which means that for every unit of demand growth that we get, no matter how puny it may be, could be inflationary if supply is very weak. We always look at GDP, GDP, GDP. GDP is about spending. That's demand. Nobody ever talks about what about aggregate supply. You only talk about aggregate demand because, of course, we're consumed with spending. What did GDP do? Consumer spending, construction spending, government spending. The supply curve, you can't forecast inflation with just one curve. You need to have supply. Supply is what? What goes into supply? Really, capital, labor, and land. Well, land is fixed. We have capital and labor. Well, we know that available labor supply, we know the participation rate, which already got impaired, especially the female participation rate, got impaired in this pandemic. And we could have a situation where we're going to have a lot of pooled of long-term structural unemployed coming out of the situation. That, by the way, is cost push inflation, a lower labor pool for companies to draw off of. So I'm focusing on the participation rate as a supply side. I'm also looking at the productivity numbers. And I'll tell you what has always concerned me. Look at when people say to me, let's can't wait to go back to the old normal. What was that old normal? What was the old normal? Think of what happened in these past 10 years. We had the weakest economic cycle of all time. Do you know that? Weakest economic cycle of all time. And the stock market went up fivefold. How is that even possible? And I was saying this, that the stock market and the economy became so divorced from each other, from reality. And it's because we had an earnings cycle that was an earnings cycle called earnings per share. And what companies did was they embarked on the biggest debt for equity swap of all time. Think about that. When I went to school, when I went to school back in the 80s, how naive was I to pay attention to the economic textbooks that when companies issue debt, they issue debt to finance capital expenditure so that they can boost productivity and generate some internally charged rate of return that would more than compensate for the initial cost of capital. Well, that's in the textbooks, right? What happened this time was the biggest corporate debt spree of all time to buy back stock. Boost your earnings per share.
Yep.
The CEO gets to have his job. But the problem is that we had the weakest capital deepening, the physical capital in the private sector capital stock, Canada, United States, weakest 10-year period of all time. And there's a time-worn link between capital formation and productivity. So here's my concern on the inflation side to round this part up is we end up with very weak labor force growth and almost no productivity growth. And it means that even if the new normal is going to be something like 2% aggregate demand growth, but only say 0.5 or 1% supply growth, guess what? Inflation comes back a lot more quickly than I'm suggesting right now. So this is not the benevolent demand pull inflation where we got inflation because the economy is vibrant and companies have pricing power. No. This is called cost push inflation. Mm-hmm. Cost push inflation in the context of weak aggregate demand is otherwise known as, for those people that were around in the 1970s, know what I'm talking about. It's called stagflation.
Stagflation, yep. Scary stuff. There's a lot of social implications to unpack from what you're saying as well. the fact that labor pool isn't going to be what it's like, and you've quoted in your research as many as maybe 10 million people have lost their jobs, maybe not being able to come back. It's not the 1930s where you could come back with unskilled labor. Those manufacturing jobs, those are all gone. At the same time, we're seeing the rise of socialism, right? I mean, in the States, Bernie Sanders was probably unimaginable in the 80s and 90s. How are these things all interlinked? What does the Democratic victory mean? This isn't Barack Obama's or Bill Clinton's Democratic Party anymore. AOCs have a very different view of the world. Is this going to have negative implications for economic growth in the States and in the world?
Well, I think that the U.S. election was really interesting, and you got to be thinking that Donald Trump, not for 1 month, got over 50% approval rating. He would end the election with 45%. I think that virtually everybody outside of his core base knows the character, or I would say even lack thereof. And he still got 72 million votes, which is absolutely remarkable. And I think that the big headline on the election wasn't that Trump lost, although he's fighting it hard. It's how did we not have a Democratic landslide? And in fact, the blue wave, all we heard what was the blue wave. We didn't get a blue wave. And so we'll have to wait for those January 5th, 2 Georgia runoffs. I'm assuming that those 2 seats will go to the Republicans. But it was very interesting to see the House majority for the Democrats go down as much as it did. I mean, it looks like it could be at least 10 seats. And that hardly ever happens with a president being elected from the same party. So there's a real message here that the country seems to want to go center right, that they do not want to have tax increases. And this was a vote against tax increases. It was clearly a vote against a lot of things, but it was a vote against tax increases. And that showed through even down ballot. There were many states in the House side where tax increases were on the table. They got voted down. So nobody wants to see their taxes go up. I tend to find in Canada, people don't like it. But taxes, since the days the Liberals got elected in 2015, taxes have gone up. You can't even raise taxes in the United States for people making over $400,000. So this is a real bottleneck, because you got to be thinking, if we don't raise taxes, and we're not going to cut spending, and who's going to be cutting spending? Nobody's going to be cutting spending. And in fact, the demographic pressures are such that cutting spending will be next to impossible. But we're not going to raise taxes. We're not going to go through some sort of national soul searching on income inequality, which is a big problem.
Yep.
And so, people will say, well, boy, this is a vote for gridlock. Gridlock is good. Yeah, it's a vote for gridlock. You got McConnell here, Pelosi there, and then you got Biden. Biden is reportedly a great deal maker. We'll see how this goes, but it's telling me that we're not going to be getting a fiscal solution. There's only so much. Biden will be able to do a lot regulatory-wise, but not the sort of things that need to be needed to address the massive mountain of debt and deficits that will continue to accumulate. Because you're quite right. We certainly don't want to have anarchy or social instability. We're going to have a mountain of long-term unemployed that we didn't have before. They will have to be supported. So whatever the new normal is, people think we're going back to some normal. Well, the normal coming into this pandemic in the United States was $1 trillion deficit. That's one thing that Donald Trump gave us coming into the pandemic, was a dilapidated federal government balance sheet. In Canada, it was more the provincial governments that had the dilapidated balance sheet. But the balance sheet is the balance sheet. We look at Canada, United States, corporate, household, government, the highest debt to income ratios of all time, and now it's going to be a permanent feature. How's it going to get financed? So it's telling me that when I'm thinking about the future and I'm thinking about the tail risks, and it's maybe not even a tail risk anymore. It's something else, by the way, that might influence my inflation view, is what happens if we actually embark on debt monetization, the debt jubilee, and so that's something that you have to consider. That I don't know who the Treasury Secretary is going to be. a lot of people are saying it could be Janet Yellen. And remember, and then who could be Treasury Secretary is somebody who's already on the Fed, who's a classic, I would say left-wing Keynesian. It's not an insult. She's brilliant. Is Lael Brainerd. She goes to Treasury. You could have Yellen, or you have Brainerd take over the Fed at some point. You have Yellen at Treasury, and you got two people that I think would be very, very pro debt monetization, which is otherwise what is called the debt jubilee, which is actually another form of MMT. And I think that's what we're going to be going to. Now, if we embark on monetizing the debts, which we're very close to doing right now, but not outright, that's one of the ways ultimately that you default your way out of the debt. You don't actually do a technical default that gets the rating agencies all up in arms, but you try to do your best to reflate your way out of it. And so I think what comes out of this election, because we're not going to be getting any major fiscal thrust, it means the central banks become that much more aggressive. Well, look how far they've gone already. We've seen the central banks that they will be extremely aggressive. And I think that would be one solution. And the reason why central banks have not really done outright debt monetization is because it's a massive experiment. This is more than just doing quantitative easing. This is a situation where you can, as a central bank, lose control of the monetary base. Now,
David, sorry, what's the implications for the U.S. currency under a debt monetization?
Well, you see, under that scenario, the U.S. dollar gets trashed, which is what I was going to say, which is that it would have to be a G4. It would have to be the Bank of England, the BOE, the BOJ, the ECB, and the Fed. They would have to do it together. But look, they've done everything else together, right? They've, starting in 08 and 09. So it would have to be coordinated, or else the U.S. dollar would get crushed. Right. So maybe it becomes, but gold once again in that environment, because if you're going to ask me, that would be a shock, outright debt monetization. Like, we're talking a situation here where what happens with this? People are going to ask the question. What happens is this. What happens is that the Treasury places a $10 trillion perpetual bond on the Fed's balance sheet, and the Fed then prints the money and gives it to the Treasury to do with it what it wants. It could retire debt, or it could spend the money and bypass Congress. So that's what I think is going to be the end game, depending on how big the output gap is. That would be certainly something that would cause me to change my view on inflation from a policy shock standpoint. But it would be definitely, that would be, if you remember going back, if quantitative easing, or what I call QE light. Whoever thought we call it QE light when
is that the point we're calling it QE light?
Well, now? Gold went up 40 to 50% in that first era of QE. Imagine what it does in an era of debt monetization.
Unprecedented numbers. David, we have so many questions from the audience here. I don't want to hog all the time to myself, although I have so many more questions, but I will shelf mine in the interest of the audience. Let's get through some of these. David often refers to investments with utility-like characteristics. Can he elaborate on the specific characteristics he likes to see while touching on hard assets and not just the equities?
Right. Well, what I was getting at was this. We had even as of today, with all the stimulus, the personal savings rate in the United States is 14%. The old normal leading into the pandemic was 7%. We actually just wrote a report on where is the new equilibrium savings rate. I want to make this point, make it emphatically. When I talk about a fundamental shift in behavior, we went into this pandemic with over half of the households in North America, over half of the households did not have enough savings or liquidity, cash on hand to get through 3 months of an idling in economic activity. Think about that for a second. I mean, in the context of unemployment rates that we hadn't seen in 5 decades, over half the household sector didn't have enough savings to get through 3 months of idle activity and had to rely on the good graces of the federal government in terms of handouts or income transfers, to be more polite. So how people approach spending and saving is going to change materially. We're into a new and permanently higher level of the savings rate. I would submit to everybody in the group, and I'm going to sound like a professor again, that the most important behavioral aggregate out of all the data is the savings rate that comes out of the national accounts. the savings rate, the collective decision in the consumer sector, how much am I going to spend on my paycheck and how much am I going to put away? And you put away some for retirement, or you should, but you should put some for a rainy day. Nobody had, or few people had, the people that needed it didn't have enough money to get through. I'm talking about precautionary savings. So I'm talking about that when I'm talking about the utility-like characteristics, is you want to focus on companies that cater to what you need, not what you want, what you need. So that would mean healthcare. That would mean consumer staples. That would mean some segments of technology. Like basically, when we talked about turning your home into your workstation, all of a sudden that means that that wiring your home. We're talking about internet infrastructure, cloud computing. We're talking about anything that's digital or has an online service presence. Do not notice all these grocery chains now, online delivery. So, could you argue that Microsoft has become an essential or utility-like characteristics? Absolutely. Yeah. Could you say that about Amazon? Absolutely. You might even say that somehow about Netflix to some extent. Yeah. But there are, and certainly I would include Google. Now, I'm not so sure I would include Facebook in there. I probably wouldn't. But even what we used to think of, these large cap tech cyclical companies have morphed themselves and have been re-rated as utilities. And in fact, I would even say utility stocks themselves, which have been hurt, just like REITs have been hurt this year because of concerns over payments as people are declaring insolvency or having trouble making their payments. You've had some areas that have been hurt this year, the banks, utilities, and the REITs, for pretty well the same reason, credit and late payments being a good part of that. I actually think there's been a very good buying opportunity in a lot of these areas. So I would say oil and gas, the same thing. Oil and gas, look, now we know for sure that people can talk about, the big concern was going to be a green energy boom in the United States. Well, it was funny. I had CNBC on earlier. They were talking about who would have known that oil and gas would have had their best week in 30 years, the oil and gas stocks, with a Biden victory. Well, because the Biden victory, he's the strongest person in Washington isn't Biden. It's Mitch McConnell. He's running the Senate. Nothing's happening without Mitch McConnell. So there's no green energy boom. And you're taking a look at some of these sectors that are in what I call, the companies I talked about before are trading at very high multiples. But there's other utility-like characteristics. And I said utilities themselves, water utilities, electric and gas utilities. The U.S. banks are trading at egregiously low multiples. Well, guess what? It's going to be difficult to run the economy without the banks. The U.S. and the Canadian banks look very good to me. So when I talk about utility characteristics, what I'm saying is, you know what? No, I don't think I'm going to buy the consumer discretionary stocks. I think that when people talk about travel, leisure, the airlines, yes, they'll get a pop for maybe a couple of months when coming out of the vaccine. You already saw a template for that, what happened on Monday. That's a trade. That's not a trend. So the trend is going to be to focus on the parts of the economy and the parts of the market that cater to a higher precautionary savings rate. And those are some of the examples that I just gave that fit into that theme.
Really, really interesting stuff. Thinking about certain tech plays with a utility lens on it. That's very interesting. That's the kind of contrarian thought that you've become famous for. David, we have a lot of viewers here. You've really outlined very strongly and very eloquently what's going on, what your thoughts around gold are. But we have a lot of our viewers obviously interested in the base metals. Now it's a diversified metals. Listen, copper performs different than cobalt, and well, it is a battery metal, but they all have their own kind of a profile. But in general terms, you've laid out the case for a deflationary environment. What does that mean for the base metals complex in general terms?
Well, the base metals in general are correlated mostly to the Chinese economy. So I would say that, look, the base metals, they've had a very nice run. It's not really a core part of my theme. I think that if we go to an inflationary environment, they also will be good hedges. The one thing they have to know about an inflationary cycle, if we get there, if that's your view, is that companies tend to want to build inventory more quickly in an inflationary world. That feeds into a positive commodity environment, much like we had in the 1970s. The stagflation was actually very good news for the commodity sector writ large, not just gold. But the link between Chinese GDP and commodities is incredible. And, it's the irony of ironies that the epicenter of the pandemic, the cause of the pandemic was China. They're the first ones out. Of course, they beat the pandemic. They didn't need a vaccine. They just basically needed a totalitarian state, say that, you leave your house, you're dead. And so they came, first economy that came out. They're by far the fastest growing economy in the world. In the next 10 years, they will supplant the U.S. as the largest economy in the world. I said before, the U.S. is primarily service driven. Well, China has a vibrant service sector, but it's still primarily a goods sector, over time becoming more service oriented. But their GDP growth is, as the U.S. is going to be struggling with 1-2%. In fact, it'll maybe even be lower than that in other parts of the Western world. China is coming out of this. I hate to say it, and this is going to be a big problem for whoever the president was going to be, dealing with China's accelerating ascendancy as far as capturing more and more share of global GDP is something that we got to keep our eye on. But I don't think that it's reversible. They come out of this. I mean, their interest rates are 3%. If there's any country in the world that has capacity to cut interest rates to stimulate growth, it's them. They never blew their brains out on fiscal policy to get their economy moving. And they never blew their brains out on monetary policy to get their economy moving. They just basically shut down the economy. And then we saw what happened. So it's not difficult for me to have a constructive stance towards the base metals sector when I have a view that the primary source of demand globally, considering that China consumes half the world's metals, their economy is going to remain at least 6 to 7% growth as far as the eye can see. And that, by the way, is with a very challenging labor force environment. The thing about China is they have tremendous productivity growth, the fastest in the world. And that's not going to change because as we were engaging in financial engineering the past 10 years, North America to goose earnings per share, China was ramping up their productivity and it's paying off right now in accelerating supply side growth. But I'd say that China is your key to success on the base metal side, and that bull market probably remains intact.
Well, it certainly feels like, if anything, this mad world, again, I'm quoting you on that, seems to have just accelerated that trend of China's rise to challenge the dominance of the U.S. My two go-tos are yourself and Ray Dalio as well. I think he has a lot of good to say. I'd love to get your thoughts. Ray Dalio's theory is the three big motifs that are going to define investing going forward. The debt, we've already covered that extensively. The wealth gap, we've touched upon that as well. And the third one being the rise of China to challenge U.S. supremacy in the global scale. Do you agree? Are those the three big factors that we need to be watching for? Is there any additional ones? What's your is that a good framework?
I would say that's 100% true. I'd add in one more, which is demographics. And I guess maybe because I was schooled in graduate school at University of Toronto by David Foote, who is Canada's most renowned demographer. And demography is 2/3 of everything. When they say demographics is destiny, that's a truism. So I think that the aging population and the implications that's going to have on savings, on consumption, and the pressures it will put on fiscal finances, Social Security, that is going to put on tremendous strain. We are getting towards the end of that tunnel. In the next 10 years, we will have a huge fiscal crisis if we don't start to address the unfunded liabilities in the pension system. And so compared to 10 years ago, look, the median age of the boomer now is getting well into the 60s and getting into retirement age. We're 10 years older than we were at the time of the last crisis. So I say that the demographic pressures in the Western world is a ticking time bomb from a fiscal finance perspective. Maybe that would feed in tangentially to what Ray said on MMT, because that's maybe that's right. Maybe that's the only way out. The problem there is, and we talked about this earlier, about inflation. And let's say we create the inflation. For decades, the central bankers wanted to create price stability. We got global deflation pressure. That hasn't been too much fun. Then you get inflation. We're going to get too much of it. But the problem is that how is inflation going to play out for these aging boomers that live on fixed income? They might get more yield maybe on their portfolio, but their cost of living is going to go up dramatically. So there's no get out of jail free card. But everything that Ray talked about leads me towards a view that, and that's why I said 5 years, not 1, not 2, not 3. But if you have a 5 to 10 year view, I think that we could go through a new cycle down the road of much higher inflation that's being priced into the forward curve right now, if you're willing to go out that far.
Fascinating stuff. David, you've been so generous with your time. We're over an hour. I want to sneak in just one last one from the audience because we have so many here and we can't get to them all. But I think hopefully it's a bit of a quick one, and it is very topical. This whole Bitcoin versus gold. So if you're constructive on gold, do you have a position on Bitcoin? Is this for real? Is it a valid alternative to fiat currency?
Look, I think that crypto is here to stay. I personally, when people ask me, I prefer gold because to me, gold is more transparent and it's less volatile. That's what I like gold. Why do you want to own gold? I want to own gold because of its stability characteristics in an unstable world.
Right.
And Bitcoin is so volatile. It reminds me actually of what sort of unstable world that we're in. I want to have the inverse of that. Right. So I don't want to, if I want to have volatility in my life, I'll just go buy the stock market. Yeah. I don't have to go buy Bitcoin. I'll go buy the stock market. If I want volatility and I want to take the downside risk, but get the unlimited upside capture, I'll just go to the equity market. Why would I want to go into Bitcoin? If I want stability and an insurance policy, I'd want to buy gold for the stability characteristics. I don't think the stability characteristics, when you look at the volatility, is something Bitcoin can really boast about.
Very well said, and I think a great note to end it on. David, it's been really a pleasure to be able to sit down and talk to you at such an intense time in our collective history together. We thank you for sharing your thoughts and your wisdom with us.
It was great to be on. Happy to do it again.
Fantastic. Thank you so much, David. Cheers.
Take care.
Bye-bye.